The S&P 500 is one of the best investments anyone can make. It gives you a consistent return without having to spend hours of your time staring at stock charts, trying to figure out the best place to buy and sell. Billionaire investor Warren Buffett says that the S&P 500 is the only thing that the vast majority of people should be investing in, but is it really that simple? Is it the only thing you need in your portfolio without having to worry about anything else? So firstly, what is the S&P 500 and how much money can you make from it? So essentially, it's a collection of the 500 biggest publicly traded companies in the American market. Think of businesses like Facebook, Amazon, Tesla, and Apple. They're all put together into one investment, and it represents a huge amount of the overall stock market. So the total value of all the companies in the index at the moment is $32 trillion. So there's no one actively picking out which investments are included in the index. They're just put in there based on the market cap or the total size of the company. On average, it'll give you a return of 10% per year. So basically, this just means that roughly every 7 years, your money will double in value. So as a practical example of this, if you put in $15 per day for a long enough period, so for 32 years, you will have just over $1 million in your portfolio. So that's a really long time, and most definitely with the S&P 500, you can make a really good return, but it has to be a long-term perspective. I like to think about it as a high-interest savings account that you're using for your retirement. You're not going to become a millionaire overnight or make hundreds of thousands of dollars in just a few months or even a few years with this investment. Of course, the more money you put in, you will get a greater return, but you can get a very, very impressive result from this with just a small amount of money if you're willing to be patient with it. If you compare the returns of the S&P 500 with a savings account from a bank, which might give you about 2%, if we do the same example over 32 years with investing $15 per day, you'd only have just over $220,000. So between the two options, there's over an $800,000 difference in the amount of money that you'd get. So I know that it doesn't sound very exciting to have to invest into something for decades at a time, but it is a proven strategy and it will work. You're hard pressed to find anything else that will give you such a good and consistent return by putting a relatively small amount of money into it on a consistent basis. And of course, I know that past performance doesn't always indicate future performance, and there's some variability with the S&P 500 in terms of the percentage return that it gives you. It can be a little bit lower than 10%, but over decades at a time, if you spread out that return, it'll give you about that 10% in the long run. It also has a track record of over 100 years, so out of everything you can buy in the stock market, it's got a pretty good history to back up what it can do. And the way this return works is through something called compound interest, and this is basically where you earn interest on your interest. If we take a look at an example of a penny that doubles in value every day for a month, try and figure out how much that would add up to. What do you think a penny would be worth if it doubled every single day for an entire month? So initially on day 2, obviously it's just going to be worth 2 cents. And then on day 3, it'll be 4 cents. But as the days go by, the jumps get bigger and bigger. On day 10, it's worth $5.12. On day 15, $163. And then on day 20, it's all the way up to just over $5,000. And then as you get near the end of the month, the jumps get really, really impressive. On day 25, it's $167,000. On day 29, it's $2.6 million. And finally, on day 30, that 1 cent or the penny turns into $5.36 million. So the power of compounding is really impressive. You can see on the stock graph that in the second year, you have put in $10,080 of cash, and you will only have made just over $500 in compound interest. But as you scroll through the years, these jumps get bigger and bigger. And you can see it on the graph that the difference between the amount of money that you put in and the returns that you make get really quite impressive. So in the 20th year, you have put in 100K, but your portfolio will be valued at over $280,000. So $180,000 of profit made purely from compound interest. And then as you get to the end of your investments, you'll have put in $161,000 in cash, but your portfolio will be worth over $1 million. So it's a really big difference with how much money you you put in and the interest that you earn from it. So this really opened my eyes to the returns that could be made in the stock market, and that investing didn't actually have to be complicated, and it wasn't really as exciting as I thought it was going to be. So in terms of actually investing into the S&P 500, retail investors like you and me can't directly put our money into it. We have to invest into an ETF or an exchange traded fund that tracks the S&P 500. So there's a lot of financial companies that make their own ETF products. Some of the major companies are Vanguard, iShares, and BlackRock. So personally, I invest into VOO, which is the Vanguard S&P 500 ETF. So these financial companies have a license to create an ETF product that will track the S&P 500 index. So the same way that me and you can purchase a license to use some of Adobe's products like Photoshop, these financial companies can purchase the license to create an ETF. Because the ETF is a financial product, these financial companies will make money from retail investors buying the ETF product. It's not a lot of money to invest into the ETF, but there is a small transaction fee that Vanguard or iShares or BlackRock will be able to collect and make money from retail investors wanting to buy that specific ETF. So once you understood all of that info about the S&P 500, you're going to have to actually go through the process of buying some shares or investing into it. So to do that, you'll need a brokerage platform. Now, which one you pick varies depending on which country you're in, because some of them are region specific. So for America, obviously there's Robinhood. In the UK, there's Webull or Free Trade. In Australia and New Zealand, you also have Stake. And if you're in New Zealand specifically, there's Sharesies and Hatch as well. So I've got an affiliate link for some of these products down below in the description box if you want to get a bit of a sign up bonus and some free money when you're first making your account. So the main thing to consider is the security of the platform, the fees that it charges, and how easy it is to navigate depending on how much experience you have. There are some really technical platforms that provide lots of detailed financial information that at first glance can be a bit overwhelming if you're first starting out with your investing. Brokers that can be a bit complicated include Interactive Brokers and TD Ameritrade. They are really good platforms, but when you're first starting out with your investing, understanding these platforms can be a little bit difficult. So all major brokers are easy to use. They have quite low fees. They're made to be beginner friendly, so you can't really go wrong with any well-known brokerage platform, and they're all pretty much the same. If you can use one of them, you can use all of them. And when it comes to investing in the S&P 500, it's really good if you choose a broker that lets you set up an automatic payment. So just having a set amount of money that you're going to take from your bank account and go into the brokerage platform that will then invest that money into the S&P 500. So you can normally set this up to be a daily, weekly, or a monthly investment as well. But this is a really good way to set things up because you just have a set and forget strategy where your money's coming out of your bank account and going into that investment automatically without you having to physically do anything. Because if you're going to be investing for years and decades at a time, you don't want to have to be constantly thinking about it every single week and doing a manual transfer. An automatic payment is what saves you the most time, and it just lets that money grow in the background. Ideally, you don't want to be checking your phone every day or every month or every couple of hours to see if your investment has gone up or down. The daily, weekly, or monthly price changes really don't matter. Even the yearly ones aren't significant because in the long run, you're going to eventually make a profit from it, but you do just have to wait. There's going to be crashes, there's going to be recessions. At times, your portfolio might come down over 30%, which is completely normal. You just have to hold on and be consistent with your investing. So for this example, I'll be investing using the brokerage platform Stake. So all you have to do is click on the search icon in the top right hand side of the screen and then select what investment you're wanting to buy. So if you can use one of these platforms, you can use all of them. If you understand how to use Stake, you'll be able to jump on Robinhood and Webull with no problem. So they're virtually all set up exactly the same. So we'll click on search in the top right side of the screen and then we'll type in VOO, which is the Vanguard S&P 500 ETF, and you'll see that pop up here. So after you click on it, it's going to give you a graph that will show you some financial info about the company. So you can set this across different time points. So there's 1 day, 1 month, 1 year as well, and then there's 3 years too, or you can also have a candlestick graph as well. If you want to have a bit more of a longer time horizon for how the stock has been doing, you can just go on Google and type in the stock as well, and it'll show you across 5 years, or you can go all time and it'll show you how that stock has been doing since it was first publicly listed. So you can get a really good idea of how it's been performing over the years. So all brokers give you some technical info about the investment, such as the open, high and low, so the highest and lowest price that it's had. It'll also show the dividend yield, which is 1.59%. So you'll receive a total of just under 1.6% of your investment back through a dividend if you invest into VOO, which is just a nice bit of extra money from it. And then it'll show you some news articles about the stock as well, so you can get a bit of an idea if there's any major news info you need to be aware of before making your investment. And then there's some other technical info that's restricted unless you have a premium account with stake. So in terms of the buying options, I always just go with market buy, which is buying the shares at the current market price. So you can see that VOO is $386. So when you hit market buy order, you're going to be buying the shares at that current market price. And then you would just enter the amount, say it's $100, and then click on review buy, and then the shares will be purchased for you. It takes about 2 to 3 days for that to get processed, and then you have your own shares of the S&P 500, and that's all you need to do. It can be done in a few minutes, and it's a really easy, straightforward process. It can seem a lot more complicated than it really is when you first start out and haven't done it before. But when it comes to investing, there's other options available, like investing in dividend stocks that can secure you a consistent stream of passive income, and you can actually take that money out on a weekly, monthly, or yearly basis. You don't just have to be restricted to selling your investment after you've been buying into it for decades at a time. If you want to see a complete step-by-step guide on how to start dividend investing and how you can actually live off your dividends and secure some passive income from them, then check out this video on screen, which will give you a complete guide on how to get started on your dividend investing journey.